Hello and welcome to the channel. If you are an investor in the stock market, this video is very important for you because today I'll discuss a topic that will not only help you save time, energy and mental stress, but also help you make more money than most people who waste enormous amount of time and energy trying to buy and sell stocks every day. I will present the findings of a research study that examined the long-term performance of stock trading accounts of 66,000 households, analyzing their returns compared to the amount of stock trading activity. Most people on YouTube ask you to constantly buy and sell stocks to make profits. But the findings of this study might come as a big surprise to you, especially if you're a stock trader or who is planning to be a stock trader. With that said, let us get started. My name is Kanak and welcome back to my channel. To learn more about investing, finance and economics, subscribe to my channel. And I've just launched a new course, Complete Guide to Stock Market Investing, where I offer a step-by-step guide to building a long-term investment portfolio and explain the fundamentals of investing. Check out the description for the course link. Alright, so the research paper we will discuss is titled Trading is Hazardous to Your Wealth, the Common Stock Investment Performance of Individual Investors. This paper was published by Brad Barber and Terence Odian in the Journal of Finance in the year 2000. The study analyzed brokerage accounts of 66,454 households from the period 1991 to 1996. It examined the relationship between returns over a 6-year period and the amount of stock trading activity. As a stock trader, you might think stock traders make a lot of money and generate more returns than the market. But the study found an inverse correlation between stock trading and returns over the 6-year period, meaning the more an account traded stocks, the lower were its returns, after accounting for all the expenses such as taxes and commissions. Now let us look at a chart that breaks down the findings of the study. The chart you see on the screen might look very complex, but let me break it down. The 66,454 accounts were grouped into 5 buckets based on their trading activity. The number 1, that is low turnover, represents the accounts that traded the least, while the number 5, high turnover, represents the accounts that traded the most. The length of the grey bar represents the amount of trading activity, and the buckets are ordered from lowest trading activity to the highest trading activity. Now the length of the white bar represents the gross returns, which means returns before taxes and commissions. And the length of the black bar represents the net returns, meaning returns after subtracting all the taxes and commissions. As you can see, as we go from bucket 1 to bucket 5, net returns represented by black bar decreases, while the trading activity represented by the grey bar increases. So to summarize the conclusion from this chart, we can say that the accounts that traded the most generated lower returns compared to the accounts that traded less. Now there is also a second important observation in this study. As you can see, the net returns represented by the black bar is lower for the average individual than for the S&P 500 index. This means that an average individual who buys and sells stocks generates lower average returns than the market, after accounting for costs such as taxes and commissions. This might seem very strange, right? Stock traders put in so much hard work and still generate lower returns than the market. Well, similar findings were reported by studies conducted by other financial institutions. Now you might argue that these accounts were not managed by professional money managers, so they could not generate higher returns than the market. However, over the long term, even mutual fund managers fail to generate more returns than the stock market. As you can see on the screen, this table shows how many mutual funds have failed to generate more returns than the index. If you look at the columns for 10 years, 15 years and 20 years, you will see that more than 90% of mutual fund managers generate lower returns than their corresponding index. Generating higher returns than the market consistently over 20 years is a very difficult task. Remember, the word consistently is very important. Someone might generate higher returns than the market over the short term, but doing so consistently over 20 years is not an easy task. An important question that you might be asking is why stock traders are not able to beat the market. The study mentions several reasons why stock traders and everyday people generate lower returns than the index. Firstly, taxes and transaction costs such as commissions play a significant role in reducing the returns. This study was conducted in 1990s when commissions were very high. Today, in the age of online trading, the cost of trading is almost negligible. However, taxes remain a real cost, and short-term capital gains tax is as high as 20%. So even if you make a profit in the short term, you will end up paying 20% of your profits as taxes to the government. So costs such as taxes and commissions work against stock traders over the long term. Another important reason, often ignored by stock traders, is the presence of various human biases such as overconfidence bias, recency bias, anchoring bias, survivorship bias, and many more biases that can cause them to make poor trading decisions. When buying and selling stocks, these biases can affect your decision-making process, even if you're unaware of them. These psychological errors can lead to poor trading decisions that can significantly hurt your investment returns over the long term. Most of the time, we are not even aware of our own biases and poor judgments. I've created a separate video where I explain each of these biases in depth. You can check out the link in the description below to learn more about the different types of human biases. In summary, what we can learn from the findings of the research paper is that stock trading has an inverse relationship with long-term returns. In simple terms, or in simple words, the more one trades stocks, the more likely it is that one generates poorer returns in the long term. Additionally, costs such as taxes and commissions have a significant negative impact on returns, and human biases play a vital role in leading to poor judgments by the stock traders. Thanks for watching till the end. Hit the like button and subscribe.